So one of the most complex, regimes of tax in India, I would say, is the capital gains tax regime. Now, you have different asset classes. Around the world, you have them. But in India, different asset classes have different holding periods. For example, a holding period is how long you need to hold the asset for it to become a long-term asset. Why do people want to keep their asset as long-term? There's reduced rates of tax, and you get something called an indexation benefit, where the cost of acquisition is increased to bring it in line with the cost of inflation. So 10 can become 12, etc., depending upon the year in which you bought it and the cost of inflation index. So we have three different holding periods. We have 12 months, 24 months, and 36 months for an asset to become long term. Listed shares is 12 months, for example. Immovable assets like real estate is 24 months. Listed units of REITs, InvITs, etc. is 36 months. Not only that, the tax rates are very different. They move from 10% to 30%. For example, long-term capital gains, except on listed equity shares, is 20%. Listed equity shares is 10%. Again, on gains of over 1 lakh rupees. Short-term capital gains depends upon a person's normal rates of tax, so 30% plus, etc. So these are the two differences. The third big one is, when is indexation available? Indexation is not available on long-term capital gains. It's available on a few and not available on others. So when a person is really doing their calculations, etc., I think it takes a lot of time to figure out, when should I buy? When should I sell? Is this a debt-oriented unit? Is this equity? Is the 12 months going to apply? Is it 24? Is it 36? What rates are going to apply? So that is, I think, a change that needs to be brought in. The fourth thing, in fact, I don't want to miss that, is that there is difference in tax rates for non-residents and residents. And sometimes that again takes away the level playing field, because non-residents, in addition to whatever benefits they're getting, they also get treaty exemptions. So that is the fourth change that probably needs to be brought in. So four differences or four different buckets that are complicating the long-term capital gains regime, which need to be unified to the extent, of course, that they can. I'll give you an example for what's happening in other countries. Like some countries like Singapore, Turkey, etc., they don't even tax listed equity shares. Other countries like the US, UK, they do tax them, but they have a concessional regime for taxation of listed equity shares, certain other exemptions, etc. Other countries like the Philippines, they have a normal tax rate that they apply across the board. And even on holding periods, countries like UK, Canada, Denmark, they don't provide distinction of holding period while for different classes of assets, while the US has a distinction. The end of the day, even if we were not to really compare with other countries, because every country has their own nuances, I think even if we look at India standalone, the fact that we have different holding periods for different classes of assets, the fact that we have different tax rates for different classes of assets, even on long-term capital gains, the fact that we give indexation on certain classes and not on the others, the fact that there are different rates for residents and non-residents, makes it overtly complex. So therefore, perhaps changing all of this or bringing in changes slowly so that we have maybe not so many complications and maybe two buckets, etc., may be the call of the hour.